Now, we've had the latest growth figures for the United Kingdom this morning, and once again, they're pretty positive, more so than forecasters had predicted, confirming that this was the UK, the fastest growing economy in the G7 group of advanced nations last year. The indicators are not all positive, but they are far better than all the gloomy short-term forecasts made during the referendum campaign. And the Confederation of British Industry, the CBI, says that UK manufacturing is, quote, firing on all cylinders. So if it is, let's have a look under the bonnet of the British economy with a snapshot of some of the more important figures. Now, according to the Office for National Statistics, the ONS, GDP grew by 0.6% in the final 3 months of last year. Now, this is an early estimate. They all tend to be revised 2 or 3 times. But on that early estimate, it would mean solid growth of about 2% or so for the whole of 2016. The employment rate is currently 74.5%. That's the joint highest it's been since records began on this index in the early 1970s. The unemployment rate is also historically very low at 4.8%. Figures out today show that 1.72 million cars were built in the UK in 2016. We haven't built that many cars in this country since 1999. It's not all good news for the automotive sector. Investment in the industry dropped by about a third to 1.66 billion in 2016. It was 2.5 billion in 2015. What we don't know is whether that's just the investment cycle or people holding back because of uncertainty before they invest further. The pound has fallen significantly against the dollar since the Brexit vote and against other currencies too. It reached a 31-year low last October, but has rebounded a bit since then and rebounded more this week, still well below where it started. Inflation has also been rising. It's currently at 1.6%, according to the CPI index, not short now of the far short of the bank's target of 2. It's the highest it's been since July last year. So these are some of the economic indicators. Though, of course, there are plenty of others. Let's have a listen to the Chancellor, Philip Hammond, as he responds to this morning's growth figures.
The figures today, which are very good, show the resilience of the UK economy and point to the bright future that we have as we go into this period of negotiation with the European Union based on the very clear agenda that the Prime Minister set out last week.
That was the Chancellor. We're joined now by 2 economists, that noble profession which was said to have suffered its Michael Fish moment before the financial crash and during Brexit. It's Danny Blanchflower and Liam Halligan. Welcome back to both of you.
Hello.
So, the economy growing by around 2% in 2016. It's not great, but it's better than anybody else in the G7, and it's not what the Remain campaign, David Cameron, George Osborne, the Bank of England, the IMF, the OECD, and the World Bank and others said would happen.
Well, the Bank of England acted. And so, no, don't smile. The Bank of England acted.
I wasn't smiling.
I was raising my eyebrows.
The Bank of England acted. The indicators were bad in August. And so they cut rates. No, absolutely. They cut rates. They did QE. That raised confidence. The economy is about as good as it's going to get. And from here, the indicators are not great. Investment intentions and employment intentions are very weak. So it takes time for things to have an effect. Fortunately, the bank acted, and the counterfactual would have been much worse.
Do you, though it was interesting that the economic models at the time didn't assume no policy change, whereas I think it was predictable that the bank would have reacted.
Right.
So to that extent, the models were misleading too. Do you accept, though, it was the cut of 25 basis points?
It was a PR-driven cut. Things take time to react, says Danny, and yet he says the economy turned on a sixpence just because we cut interest rates by another 0.25%. You know, here we are, Andrew. The Treasury said we'd have an immediate and profound economic shock.
Well, that was silly. You know that was silly.
Well, it was repeatedly described as fact by the Chancellor of the day, and yet here we are with the manufacturing PMI, thankfully, above 56%, where 50 indicates growth. Services PMI also above 56%. Pretty buoyant GDP numbers. Now, I agree with Danny in the sense that the longer Brexit goes on, the more uncertainty there is about Brexit, the more that will affect investment going forward. But for now, at least, the UK economy remains pretty resilient.
Why did you smile?
Because cutting rates from 0.5 to 0.25, I can't believe has any effect on the true economy whatsoever. I mean, the QE might have helped a little bit, but, you know, I'm sorry, when you get down to these low levels of interest rates, cutting further, I mean, that's the fundamental problem for many central bankers around the world, is what more can they do to stimulate the economy? So I cannot believe that...
Negative.
No, I don't,
exactly.
I
So
don't
the bank,
agree with
what the
that.
Bank of England did had very little effect.
I agree with some of it, and I disagree with some of it. Essentially, what they're showing is that the bank's on the case, and so that had an impact on people. But you're right, the bank doesn't really have very far to go. The reality is actually the bond buying, we're buying the bonds of American companies. So there's a limit to what the Bank of England can do. The reality is that a recession's coming. Recessions come every 8 or 10 years. We're 8 years in.
When is this recession
Well,
coming?
I'm not saying I can predict it exactly, but if you're 8 or 10 years in, that's what the business cycle is. We're 8 years in, and you're quite right to say the bank is very scared. It has nowhere to go.
So we'd have a recession then, in your view, with or without Brexit?
We would be having a recession with or without Brexit.
Remember that when he blamed it on Brexit.
No,
in
I'm
6
not.
months' time.
No, I said that before. I said
Mark
that
this
before.
tape.
No, but I just say I think the timing of Brexit was really bad because a recession was inevitably coming fairly soon, and then you put a negative shock on the economy.
The biggest danger this economy faces, the world economy faces, is one, the potential implosion of the Eurozone as it goes through political turmoil over the next 6 to 12 months. Not that I wish it to happen. No. It's our near neighbour. But the euro has so many internal inconsistencies. The even greater danger is the unwind of this absurd QE policy, which Danny and other central bank policymakers supported to the hilt. That's what markets are really worried about.
When I look at the economic models that got their predictions wrong, the reason they got it wrong was very little to do, I would suggest, with whether there was more QE or a minuscule cut in interest rates. It was because they assumed that the British consumer would be as frightened of Brexit as they were, and the savings ratio would rise and consumer spending would fall. That didn't happen. Indeed, the savings ratio fell. They got it wrong for that reason.
No,
now,
that's
can you not accept? I want to come on to the future because that's always more uncertain. Though sometimes the past is uncertain for economists.
No, but you don't know where you are. You don't know where you are. You don't know where you're going, and you don't know where you've been.
That sums up economics.
That's exactly right.
Economics.
All right, let me ask. Can you, before we move on to this year, can you not accept that you and these forecasters, you got it wrong, and the economy has performed better than even the Brexiteers thought it would?
I think that's true. I agree with that. It certainly performed better than I would have thought. But...
There's always a but.
No, but I think the consumer has behaved in a way that I hadn't expected.
Irrationally?
But it's unsustainable. Entirely and utterly unsustainable. We've just seen a big fall in retail sales that you didn't talk about. The CBI retail sales survey today is very weak. And we have inflation rising, and we now have wage growth falling. If you take the RPI, which is the figure used in wage settlements, that's at 2.5. Very soon, there we are, 2.5 RPI.
You're warning me about inflation now, Danny.
Well,
that's ironic. You battered me about it.
No, I'm right. You know I'm right. You know I'm right.
I mean, Danny, we all know that depending on what statistics you pick, you can say anything. The US has 1 million different sets of economic data, and economists still can't forecast what's going to happen. So, you pick out one piece of economic data, Liam picks out another, you say it's bearish, you say it's bullish. I mean, that's the problem, is that you have to look at a whole load of them and
Louise, with respect,
guess.
With all respect, we're an advanced industrialised economy. The GDP number is pretty hard to spin. It is the GDP. However much the Treasury tries, it is the GDP number.
I'll give you a spin.
Yeah, it is the GDP
I'll give you a spin.
1.4%
of GDP per capita, plus the data we have out today. You won't like this. This is now proven the slowest recovery in 300 years.
But we knew that already. It's a slow recovery. That's not the UK. That's the US.
That was the case in 2012 before we had a Brexit referendum pledge.
But hold on.
Everywhere.
Hold on a minute. Most economies have had a pretty slow recovery.
Yes,
the Italian.
We are now 9% higher in GDP terms than before we went into the crash. The Eurozone this year only got back to that level. There's nothing. There's nothing unusual about that. Everybody has been slow in recovery, and some, like Italy and chunks of the Eurozone, haven't recovered at all.
Andrew, hang on. Andrew, I am the last person in the world to say that you should have been in the euro area area, not have your own central bank and currency. It was crucial to have that, to have people like me who were able to cut rates and do the QE that he hated.
You did a great job.
Because the fiscal authorities had no idea what they were doing. And the reason the last 7 years or so has been the time of the central banker is because of the utter incompetence of the fiscal authorities.
Right, let me move on to this year and possibly next. Just because the forecasters got last year wrong, their short-term forecast, and I think it's irrefutable that they did,
Yes.
even Danny has admitted that, doesn't mean they'll get this year wrong, though, does it? I mean, what do you say to the city consensus, the OBR, that growth is going to fall below 1.5% this year? Are they going to be proved right, or are they going to be proved wrong again?
I am actually pretty bearish for this year, because the longer the political classes strings out this slow-motion Brexit madness, the more business incentives to invest will be dented. For the most part, practical business people in small businesses and large, whatever they were saying on the airwaves, realised once Brexit had happened that we should just get on with it, and it wasn't really going to affect us all that much. But if they see the political classes making a complete car crash out of this, spreading economic uncertainty over the next 5 to 10 years, getting the UK into a Quebec-style never-endum if we have a second referendum, that's going to hit our credit rating.
It's the first time I've ever agreed with everything he said.
Right. I'll do my best to change that in a minute.
Get used to it. Get used to it.
It's quite a lively debate, Andrew. You're doing a very good job of controlling us all.
What do you think is the prognosis for this year? Do you think that actually we could do better than the city consensus?
It's really interesting. There is this consensus, and it's all about consumer spending. It's all about inflation going up, and wages not keeping up with inflation, and consumer spending. That's basically everybody is saying that.
They must be wrong.
That is kind of what I think, actually. I do, because so often the consensus is wrong. I think we might have a booming year. I mean, booming in the context that 2% is good, and the US only grew at 1.6% last year. We get the fourth quarter GDP figures on the US tomorrow. But in the context of really quite slow growth, I think the UK could do all right this year.
Let me give you a couple of reasons why it might be better than the city consensus to get you to react to it. One, there is going to be a massive Keynesian Trump reflation in our biggest national export market, called the United States. Secondly, our biggest export market in terms of a regional bloc, the Eurozone, it's still going to grow about 1.5% this year. It's not great, it's about the same as last year, but it's growing. Hasn't done that much recently since the Greek financial crash. Sterling has had this amazing competitive devaluation, which will help. And average earnings could still stay ahead of inflation. If all that was to happen, wouldn't the city consensus be wrong?
Right. I think inflation's going to rise, and I still think wage growth is going to fall. But I think the first point you said, I mean, I live in America. I think the chances of a large fiscal stimulus actually taking place in 2017 is almost zero.
Why?
Well, a number of things. First, because you need people in place to actually implement it. He needs to appoint 4,000 people to actually implement things. He's appointed 60. So the practicalities of doing it first are limited.
You don't need many people in place to cut taxes.
Well, let me finish. The other thing is that we have a position whether the people within the Congress are going to do this. And when you listen to the nominees and when you listen to the nominations that we've been listening, just to start with, let's think about if you abolish. So Trump says, I'm not going to abolish Obamacare. I'm not going to touch Medicare, Medicaid, and Social Security. And his nominees in those positions say exactly the opposite. We have a budget director who's in place who says the main thing we need to do is to reduce the budget. So we have a confusion. I mean, I just think that the likelihood of it's actually taking place and having an impact in 2017 is zero.
Congress will take the tax cuts, but they won't give him the spending rises.
Exactly.
Because
he hopes a lot of the spending rises will be done by the private sector.
You'll end up, I think, Andrew, and I've written this for many months, you'll end up with a debt ceiling crisis, just as Congress imposed on Obama. Because a lot of the Republicans in Congress, they're hawkish. The Laffer curve takes a long time to kick in. That means tax cuts do lead to more borrowing.
All right, we have to.
And rates may well rise. The Fed may well be raising rates too.
I wouldn't say there's any doubt about that at all.
But not as much as Yellen says.
Absolutely.
But we have to bring this to an end, but I'm just going to park it there and get it measured that the two of you are now saying there will not be a Trump reflation this year, that he won't even get to implement it.
Via a big fiscal boost.
It's not what the stock market says.
Maybe because of other reasons.
Yep.
Look, you've made your forecasts, you've made your bed, you will not lie on it, and you will be held to account to see if you're both wrong yet again.
argued less than I thought, actually.
I know, I'm very disappointed. I'm not having you two
You're not
back.
having you two back on it again.
Useless. Totally useless, Louise.
The Chuckle Brothers.
Now, who thought that economics could be so much fun?